The Freightwaves Supply Chain Pricing Power Index uses the analytics and data in Freightwaves sonar to analyze the market and estimate the negotiating power for rates between shippers and carriers. This week's Pricing Power Index is based on the following indicators. Consumer debt is a looming headwind for future freight demand. In terms of freight volume, truckload markets have continued to express a trend of typical seasonality. Freight demand was relatively stable throughout late January and much of February, but is now slowly beginning to ramp up at the start of March. A few factors are providing slight tailwinds to volume growth. After reaching a nadir in early February, the flow of ocean freight from China to the U.S. is shaking off the lull created by the former country's Lunar New Year celebrations. Produce season, which first affects markets in Florida and Texas, including Texas cross-border markets, is just around the corner. This week, the Outbound Tender Volume Index, OTVI, which measures national freight demand by shippers' request for capacity, rose 3.85% on a week-over-week (WW) basis. On a year-over-year (YY) basis, OTVI is down 30%, although such YY comparisons can be colored by significant shifts in tender rejections. OTVI, which includes both accepted and rejected tenders, can be artificially inflated by an uptick in the Outbound Tender Reject Index, OTRI. Contract Load Accepted Volumes, CLAV, is an index that measures accepted load volumes moving under contracted agreements. In short, it is similar to OTVI but without the rejected tenders. Looking at accepted tender volumes, we see a rise of 3.73% WW, as well as a fall of 16.8% YY. This YY difference confirms that actual cracks in freight demand, and not merely OTRI's YY decline, are driving OTVI lower. Earlier this week, Freightwaves CEO Craig Fuller sat down with Zach Strickland, the Sultan of Sonar, to discuss current market trends. Their conclusion, with which I agree, is that the market is presently in a confusing state of stable imbalance. Stable, because freight demand has not totally cratered and is abiding by seasonality once again, but imbalanced, because there is still a glut of capacity from the 2020-21 gold rush. Although deteriorated, contract rates, discussed below, escape from the worst possible Q1 scenario. Much worse is the prolonged atrophy in spot rates, which has proved punishing for smaller, newer carriers. A healthy number of industry analysts predict that consumer demand for goods will return in the second half of 2023, spurring truckload volumes and returning a bit more balance to the market. I am not overly hopeful about this forecast, however. On Tuesday, the U.S. Supreme Court heard arguments on the Biden administration's plan to forgive $430 billion in federal student loans. The court's conservative majority expressed doubts about the legality of such forgiveness, though some of these justices also questioned if the plaintiffs had the requisite legal standing to press the issue. Whether such forgiveness will be approved or denied will likely remain uncertain until June. Student loan repayments will resume in late August after a 3-year hiatus. Non-revolving credit, a category that includes student loans, has risen steadily over the past 5 years. This consistent trend is in stark contrast to that of revolving credit, debt which includes credit card balances. After receiving stimulus money from the pandemic measures of 2020-21, consumers rapidly paid off their credit cards and then splurged on household goods, largely neglecting to put these funds toward their student loans. When student loan repayments come back into effect, particularly if the court rules their forgiveness unconstitutional, it will majorly dampen consumers' already weakened demand for goods, driving down freight volumes and possibly kickstarting, or worsening, a broad economic recession. Of the 135 total markets, 83 reported weekly increases in tender volume, with large and small markets alike benefiting from returning freight demand. Over the past 7 days, a diverse assortment of markets benefited from a seasonal uptick in shippers' activity, including seaport markets and heavyweight industrial regions. The market of Ontario, California, which stores and distributes freight from the nearby ports of Los Angeles and Long Beach, saw volumes climb 5.68% WW. Seattle, which is both a cross-border market and a port market in its own right, saw a 14.1% WW increase in freight demand. Michigan's 2 manufacturing hubs of Detroit and Grand Rapids, meanwhile, saw respective WW gains of 8.6% and 11.11% in tender volumes. By mode, heavy winter storms drove reefer volumes in the upper Midwest and the Northeast this week, as shippers strove to protect their temperature-sensitive goods from freezing. Accordingly, reefer volumes saw their highest growth in relatively small markets, such as those of Cedar Rapids, Iowa, and Syracuse, New York. Though to a lesser degree, appreciable growth was also seen in the major reefer markets of Lakeland, Florida, and Joliet, Illinois. On a national scale, then, the Reefer Outbound Tender Volume Index, ROTV, rose a solid 4% WW. Produce season, which begins in Florida and Texas, is right around the corner, and ROTV, if it is truly abiding by seasonal trends, should see corresponding growth. Though ROTV is down 27.45% YY, accepted reefer volumes are actually up by a slim 0.9% YY. Van volumes, meanwhile, are slightly underperforming against the overall OTV. The Van Outbound Tender Volume Index, VOTV, is up 3.16% WW. As discussed above, I do not see a terribly bright future for consumer-driven van volumes over the coming months, especially since student loan repayments are set to resume right as the back-to-school and holiday shopping seasons kick off. While VOTV is down 31.2% YY, accepted van volumes are only down 18.4% YY. And like a lion, rejection rates are slowly climbing, albeit to a fairly insignificant degree. This recent uptick is less likely to mark the resurgence of tender rejections, given the persistent overabundance of capacity in the market, and more likely to signal that rejection rates have reached their point of dynamic equilibrium for the foreseeable future. A recent outbreak of severe weather, however, might throw a wrench into capacity in the coming days. Over the past week, OTRI, which measures relative capacity in the market, rose to 3.55%, a change of 12 basis points, BPS, from the week before. OTRI is now 1,512 basis points below year-ago levels. Earlier this week, load board provider Truckstop.com announced a wave of layoffs to its roughly 800 employees. The size of these layoffs, which are rumored to be the second wave in as many months, is currently unknown. On Thursday, a spokesperson for Truckstop.com did not address the layoffs directly, saying instead that the software-as-a-service company restructured its organization in order to operate more efficiently and deliver more customer value.